Ask what your business is worth and everyone gives you a range. Your accountant runs a number of a tax return that was built to pay the least tax possible. Your mate reckons a business like yours went for tens of millions. And plenty of brokers will tell you whatever gets them the listing. So nobody show you the actual numbers. So today, I will. 5 Australian businesses we took to market this year. 320,000 at the bottom, 3.6 million at the top. What the real buyers agreed to pay for each one, the profit behind it, and why every multiple landed where it did. 4 of them came in almost identical. One was nowhere near, and that gap is the bit you actually need to understand. I've helped more than 500 owners since 2012, and the question I get more than any other is this one: what is my business actually worth? And fair enough, because for most owners, that's just the biggest thing you will ever sell. You have spent 20 or 30 years building it. You get one go at getting out. And most owners are carrying a number that's either way too high or way too low. Too high, your business sit on the market for years while you go stale with it. Too low, and you hand a stranger the retirement you earn. For most businesses, you are worth a multiple of your profit. Some industry work off revenue in streams. Accounting firm, rent roll, anything with lock-in subscription income. But for the vast majority, and for all 5 of this, is profit. A multiple is just how many years of profit a buyer will pay you upfront, which means 2 numbers decide everything. First, the profit figure, and that's not any old number. That's provable profit. Profit a buyer's accountant still agree with after they have been through your books. And we always look at 3 years minimum, never 1. How we rate them depend on the business. Get that wrong, and every number after it is wrong. Second, the multiple the buyer will pay. Now, 5 real deals, real owners, real money, and a couple of decisions that took real nerve. Watch what happened to the multiple. First one, a building trades business, just under 7 million in revenue. Profit bounced, 446,000, 351,000, and 424,000. Straight 3 years average, just about 400,000. The price was 1.3 million, 3.2 times profit, highest multiple of 5. Now, here's the bit nobody sees coming. The glamour side of the business is the project work. Big jobs, some worth up to 1 million each. The stuff you would talk about at a barbecue. The compliant contract are the opposite end. Small ticket, a few hundred to a few $1,000s a job. Now, any outsider look at that and pick the projects. Bigger jobs, bigger margin, bigger upside. That's what I would have guessed too. Every single buyer went straight past the project to the contract. All of them, 500 contracts that renew, rain or shine, and they are prepaid. That's not the revenue you hope for. That's the money already in the bank before the year starts. Think about that against your own business. The work you are prouder of is probably not the work a buyer values most. They pay for what turns out without you chasing it. Second one, this is the happy one, a pet services business, turnover under 1 million. Profit of 352,000, then 380,000. 2-year average, 366,000. And you will notice only 2 years, not 3. And there are a good reason why. 2 years ago, the business changed. New model, new revenue, new profit. The last 2 years are the business a buyer is actually buying. The old number describes a business that doesn't exist anymore. Here's what happened at market. 3 buyers turned up at the same time, and one of them still never met. Neither had the owner. A few phone calls, a few emails, and it comes an offer. He didn't end up the winner, but every genuine bidder at the table pushed the price up. That's how much demand there was for the business. When 3 people want the same business, they stop negotiating with you. They start bidding against each other. Best offer, 1.1 mil, 3.01 times profit. Now, here's my favorite part of this whole deal. The entire way through, the owners never told me their number. First time in my career that's ever happened. Only after it was all done did they let it out. They have been happy with 800,000. The market went 300,000 past the number in their heads. They were over the moon. They have built something worth more than they ever knew. And that happened more often than you would think. And who paid? A first-time husband and wife team never owned a business in their life. Why would they comfortable jumping in? Because that profit figure is after paying 2 full-time managers at market rate. They weren't buying themselves a job, they were buying something that already runs with staff in it. And I want to be straight about the competition. We didn't engineer that. 3 buyers generally wanted the same business. When that happened, it was real money. Third one, commercial construction. And this one is going to feel unfair. Profit was 1.1 million, then 960,000, then 1.6 million. 1.6 million, best year the business had ever had. Imagine that's you. You just had the year you spent a decade chasing, and now you're selling. You want that 1.6 million to be the number. Every owner would. So what did the buyer price? Not the 1.6 million. The 3 years average, 1.22 million. Price 3.6 million, 2.95 times profit. Best year ever, and the buyers looked straight through it. And the owner kept asking me the same question. Why doesn't my best year count for more? And honestly, from where he stood, I got it. He worked a decade to have a year like that, and the price doesn't move. He was disappointed. Of course he was. But that's the truth I had to give him. 1 year up or 1 year down doesn't set the price. A buyer isn't buying the year you just had. They're buying the earning they think will repeat. Now, this business has 0 recurring revenue, 100% project work. But the logic of the deal that would have hurt it. So why is it still sitting up near 3? Because there was 10 million of contract work already won. About 6 million of it still to deliver. Not a pipeline, not quotes, sign work. The buyer could see the money coming. So if you're in the middle of your best year right now, here's the moral. Don't stop, keep building. The average only catches your best year when you back it up with another one. Quick one before the 4th year, and 4th one is the best story of the 5. If this is useful, subscribe. One of these a week, all of real deals. And here's one for the comment. Tell me your industry, the multiple you reckon you'll get. I will tell you if you're warm. 4th one, manufacturing. And I want you to feel what this owner went through. 3 years ago, the business made 1.78 mil. Then the next year, 1.17. Last year, 620,000. That's profit falling by 2/3 in 2 years while he's getting ready to sell. Every owner has a version of this fear, that the business sleep right at the moment. Everything depends on it. And there were reasons. Inputs cost up, energy up, plus a delivered clean out before sale. He cleaned dead stock at heavy discount. He cut overhead. All of it hammering the last year number. So how do you price that? On last year alone, the price he agreed reads as 5.4 times profit, which would be ridiculous. Nobody paid 5.4 for manufacturing going backward. So we waited the 3 years, 1, 2, 1, just under 1.2 mil. Agreed price on the business about 3.4 mil, 2.8 times profit. Hold that against the construction deal. His best year ever got average down. This bloke, worst year ever, got average up. Same rule, both direction. That's not the market being cruel, that's the market being fair. So why would a buyer stand firm on business going backward? Because it doesn't need its owner. It's down to 3 or 4 hours a day, away 3 or 4 times a year. His 2 IC run what he used to run, he can hand that to almost anyone and understand where his head was at. More than 20 years running the business. By the time he decided to sell, he just wanted to go clean it on, done, with the staff and the customer properly looked after. Now here's what it gets good. He was offered more. 4 million for the business plus about 1 million of stock, 5 million all up, full asking price. After watching your profit fall for 2 years and offer lands on the table, every instinct say, grab it with both hands. He say no, because that 5 million came with strings, when the finance and earn out tied to target, meaning a chunk of it only turns up if the business perform after he has gone. And worse, it doesn't let him leave. Terms like that keep you tied to the business for years, watching, worrying, waiting to get paid. After 20 years, this is exactly what he was trying to escape. So he took 3.4 million plus stock instead for a buyer who was better qualified, better for the business, better for the staff, and not one condition on the money. He gave up 625,000 on the surface. Now, you might think that sounds stupid, money left on the table, but look at what he bought with it. A clean exit, peace of mind, staff and clients in hands he trusted. Some things are worth more than money in the short term. The headline number is not the deal. One more thing while you are here. 2.85 is a multiple on the business, but the check the buy right includes the stock, 4.3 all up. On the whole check, that's 3.69 profit. So always ask what the number multiple is on. Business only, business plus stock. It moved the answer by the full terms. Right. One deal left, and before I show you, I have to change the ruler. Every number so far has been EBITDA, profit after paying someone a proper market salary to do the owner's job. That's the right measure when the business runs on staff. All four do still. The last one doesn't. The owner is the business. So we use SDE instead, seller's discretionary earning. Profit including what the owner takes out, because whoever buys it, buying themselves a job. Different measure, different multiple. As a rule, SDE multiples sit lower. So don't line this next number against the first four. Commercial cleaning. And this is the one that would worry some of you. Turnover 450,000, SDE about 178,000 on a 2 years average. On paper, this is a business everyone say they want 7 straight years of consistent number. Multiple property on the books, and the owner worked 14 hours a week. 14 hours, that's the dream, isn't it? The price was 320,000, 1.8 times earnings. A full turn below every other deals in this video. Here's why. 30 cleaning site, 2 clients, and before you say they will never leave, one client had been there 22 years, the other 14 years, 22 years of handshake, showing up, doing the work the right. To the owner, that relationship is everything. To a buyer, is worth zero because the buyer doesn't inherit just 22 years. They start from day one, a stranger holding nothing but an invoice. And when you start from zero, paper is the only assurance you've got. No contracts, nothing on paper. 22 of these 30 sites belong to one client. One phone call goes the wrong way, the 3/4 of the business walks out of the door. The buyer isn't pricing the last 22 years, they are pricing that phone call. And I'll be straight with you, even with a contract, concentration like this is still a risk. Paper reduces it, nothing removes it. One offer came in, a trade buyer already in the industry. Makes sense. They have got the crews and vans. They can survive losing a client in a way the first timer can't. 14 hours a week could not save the business. Customer concentration kept it. 22 years of royalty and it still couldn't buy a contract's worth of certainty. Right, all 5 back on the table. 3.2, 3.01, 2.95, 2.85, and 1.8. Building trades, pet services, construction, manufacturing, cleaning, nothing in common. 4 landed between 2.85 and 3.2. Your industry did not decide that. 3 questions did. The only 3 a buyer is really asking, is the work already locked in? 500 compliant contract, 10 million of work already signed, both got paid for. 2, does the business need you? 2 managers in pet business, 2 IC in manufacturing. Worst trading year in the whole set, and it still gets 2.85. How many customers could walk? That's the question that cost the cleaning business a full turn. And here's a test you can run tonight. Take your top 10 customers. If they are more than half your revenue, that's a red flag, and it's fixable. I've got a client who sold 80% of everything through calls, 1 phone call away from losing the lot. So year after year, he has been peeling the risk back. New chain, independence, breathing the load. It's not an overnight fix, it's a couple of years delivered work. And it's exactly the kind of thing that move your multiple. Locked in, runs without you, spread of customer. Every one of those is something you can change. None of them is your industry. So the whole thing in one breath. Two numbers set your price. The provable profit, 3 years minimum, not your best one. And the multiple, which is really just how risky your profit looks. Lock, work in, build it to run without you, spread your customer. Now, if you have been sitting there doing the maths on your own number, 3 years of profit times something around 3, that number in your head is either closer than you think or is long way off. Either way, it's worth knowing properly before you decide anything. So here's what you actually get. We go through your real numbers and it come back as a written pack, 5 to 8 pages. And it's not just a price, it's what demand honestly look like right now for a business like yours, who your realistic buyers actually are, and the specific thing you could change to make it easier to sell and worth more, even when that's not what you want to hear. No cost, no obligation, completely confidential. Links below. You don't have to be selling, you just have to want the real number.